Hey, all right. Good morning. Welcome back to the Jordan Guest Show. Today is January 29th, 2026. And yeah, I'm just getting some questions about the Trump accounts. And so I wanted to record a video and kind of break down the most recent IRS notice that lays out essentially all the details, some good question and answer in there. That is IRS Notice 2025-68. So lays out the rules for this brand new type of retirement account. It's called the Trump account, and it came out with the big, beautiful bill that was signed into law last July in 2025. Now, whether you love the name, hate the name, doesn't really matter to me when we're filing the tax returns. Like, we just need to understand what the rules are of all these different laws and accounts and how the mechanics work. So I wanted to show you all what the account looks like, the mechanics, because it's something every parent, every grandparent, and then also every CPA financial professional needs to understand. So, all right, let's go ahead and break it down. So what is the Trump account? At its core, it's a traditional IRA set up for a child under the age of 18. So we think about it like it's a retirement account that gets open when a kid is young, it grows tax advantage for years, and then it converts into a regular traditional IRA once the child turns 18. Now, the account is owned by the child. They are the account beneficiary, but a responsible party is typically a parent or a legal guardian, and they maintain the account until the child is old enough. All right, so then the big idea here is this growth period. So the growth period runs from the time the account is opened until January 1st of the year that the child turns 18. And during the growth period, special rules apply to contributions, investments, distributions. And then after that period ends, the account basically becomes a normal traditional IRA with the usual rules that apply thereof. So the pilot program is where I think it gets a little bit interesting for parents. And we've got two kids of our own at home. Of course, they aren't going to be applicable. It's not going to be applicable to them because they were born too late, at least is my understanding. So if you have a child born after December 31st, 2024, but before January 1st, 2029, the government will deposit $1,000 directly into your child's Trump account. This is a $1,000 contribution from the U.S. Treasury. To qualify, the kiddo must be a U.S. citizen, have a social security number, and then you elect into this program by filing the IRS Form 4547, or you can do it through the online portal, which is at trumpaccounts.gov. Very interesting stuff because, a lot of my friends have been texting me, hey, how do we get this set up? And, unless they had a kid last year, it really, it's not going to apply. Earliest that the money could hit the account from what we are seeing within the notice that the IRS put out in regards to Treasury sending this money out is July 4th of this year, 2026. And then this is just a one-time deal. So one election per child. You can open the account through the IRS. Yeah. So how do you open an account? So the IRS, and they're not a brokerage account, they create the initial Trump account. You make the election on a form 4547, or you can do it, like I said, through the trumpaccounts.gov, which is expected to go live the middle of this year, 2026. So then the Treasury Department will select a financial institution to serve as the trustee for the initial accounts. And after the election is processed, you'll receive information to activate that account through an authentication process. And that activation process starts as early as May of this year. The person who makes the election, they become the responsible party, meaning they can choose the investments, they can request the rollovers, they can just generally manage the account on behalf of the child. But the priority for who can open the account goes to the legal guardian first, then the parent, then a sibling that's an adult, and then ultimately a grandparent can play that role as well. Now let's talk about the contributions, because there's 5 types of contributions that you can make. So during the growth period, there's 5 ways that money can make its way inside of a Trump account. The first way is the $1,000 pilot program contribution from the government. Number 2, you can do qualified general contributions. Now, these come from states, the federal government, or tribal governments, 501c3 not-for-profits. They go equally to all kids in a qualified class. Number 3 is an employer contribution under Section 128. So your employer can contribute up to $2,500 per year to your child's Trump account, tax-free to the employee, which is very interesting. We'll probably dig into that a little bit further in another video. Number 4 is qualified rollover contribution. So this is a trustee to trustee transfer of the entire balance from one Trump account to another. And then the last one is contributions from anyone else. So parent, grandparent, any other family, friends, anyone can contribute. Now, here's the limit you need to know. So the pilot program contributions, the qualified general contributions, and the rollovers, those are not subject to an annual cap. But the employer contributions and personal contributions combined, those are capped at $5,000 per year. And that $5,000 limit, that will adjust for cost of living after 2027. And one more important detail, no contributions can be made before July 4th of 2026. Also, unlike a regular IRA, the child does not need earned income for the contributions to be made during the growth period, which is very important. So, what can the money be invested in? During the growth period, the investments are limited to what the IRS calls eligible investments. That means a mutual fund or an ETF that tracks a qualified U.S. stock index like the S&P 500. It does not use leverage. It has a total annual fee and expense of less than 0.1%. And it's not sector specific or industry specific. So there's no crypto in here. There's no individual stocks. There's no bonds, no money market funds, no sector ETFs or ESG funds. It's basically a low cost, broad U.S. index fund. The trustee is required to offer only eligible investments and must auto invest any uninvested cash into a default eligible investment. Okay, let's talk about distributions out of the account because there's a lockup period. So during the growth period, the money is essentially locked up. There's no distributions allowed out of the account except for a few circumstances. So let's go through those. So if you had a qualified rollover to another Trump account, that is allowed. If you wanted to roll over to a ABLE account during the year the child turned 17, that's good. If you need to return excess contributions, that's okay. Or if you need to distribute upon the death of the account beneficiary, and that's good. There's no hardship withdrawals, no early access. That's just kind of full stop. That's not allowed. And then after the growth period, once the child turns 18, distribution rules apply. So that means the distributions could be subject to income tax and potentially the 10% early withdrawal penalty unless an exception applies, like they've got a qualified education expense, or it's a first-time home purchase, or withdrawals after the age of 59 and a half. The contributions during the growth period are not tax deductible. The contributions from parents and other personal sources, those do create basis in the account. The government contributions and employer contributions do not create basis. And after the growth period, the distributions are just taxed under the normal IRA rules. The portion attributable to basis comes out tax-free, and then everything else is taxable. And here's one critical detail. Trump accounts are never aggregated with your other IRAs for basis calculation purposes. They're always going to be tracked separately. Now, what happens after the age of 18? After the growth period, most of the special Trump account rules go away. The account can be invested in anything a normal IRA allows. The contributions follow a standard IRA contribution rules, and the account holder can take distributions under the normal IRA rules. They can roll it into another IRA or another eligible retirement plan. They can even do a Roth conversion, but the account can never receive SEP or simple IRA contributions. And it's always kept separate from other IRAs for basis allocation purposes, like we said. So the account agreement can even include an automatic transfer provision that moves all the assets into a regular IRA right after the growth period ends. All right, so let's look at it from an employer angle. So Section 128, this is the piece where the employers and HR professionals, that's what they need to watch out for, because employers can set up a Trump account contribution program, a separate written plan. They can contribute up to $2,500 per year per employee to the Trump accounts of the employee or their dependents. Those contributions are excluded from the employee's income. The program can be offered through a Section 125 cafeteria plan for contributions to a dependent's account, but not for contributions to the employee's own account. And then here's some key dates, some action items. So I'll leave you with this timeline. So there's this form 4547 coming in 2026. So this is how you actually elect to open an account and claim the $1,000 pilot contribution. Then in May of this year, account activation information starts going out. Middle of this year, they're expecting for the online portal at trumpaccounts.gov is expected to go live. July 4th of this year, 2026, is the earliest date that any contributions can be made. So if you have a child born in 2025 all the way through the end of 2028, or if you're a financial professional advising clients with young children, this is definitely something that I just want to make sure I put on your radar because I know I'm getting a lot of questions about it. And the IRS is still developing all of the formal rules and regulations, and they were taking public comments on the matter through February 20th of this year. So you do still have time if you're a professional out there and you do want to submit public comments, you can do that. So I'm sure there will be some other questions, other things as all of this develops that we will come back on and report on. But I wanted to make sure we at least got something out there so that people have a resource to watch over and hopefully gets most all of your questions answered. I know that was a lot, so feel free if you still have any questions, you can drop those in the comments below. You can obviously you can subscribe to the channel. That would be super helpful. And then again, if you know anybody who had a kid last year or is a CPA financial professional, I think it'd be helpful to go ahead and shoot this video over to them so they can take a look and see how it might apply to their situation. All righty. That's all for today. I appreciate you all jumping on, and I will see you very soon.